foundation for high probability setups. It's always a good grasp on bias. Knowing where price is gonna go to next and giving reasons for such expectations is what we're gonna talk about in today's video. Now we're gonna start off by defining some few terms. What is narrative? Narrative is the understanding of what the algorithm will do in price next, why it should do it, and when it will do it. This is a direct quote from ICT himself. And so the next thing we're going to talk about is daily bias. Daily bias refers to overall market direction for a specific trading day. So daily bias can therefore either be bullish or bearish. Easily, right? So when I talk about daily bias or bias, if you are asked what is your bias on this particular market, you're either bullish or you're bearish. So how then do you go about determining the narrative? There's a couple of questions here that we're going to use to help us determine the narrative. The narrative, which is the story of price, what price is likely to do next, where it will do it, and why it will do it, and when it will do it. All right. So a couple of questions to help us. So what you're going to do is you're going to ask yourself these questions while looking at the price and get those answers from the market. Number one, have we taken out a liquidity pool? If the answer is yes, then price is likely to retrace back inside the range. Second question, have we rebalanced the fair value gap? If the answer is yes, then price is likely to expand towards liquidity. Then the other thing we should determine what is the present dealing range. Is price at premium? Are we at a discount? Or are we at equilibrium? If you are at premium, price will sell to discount. If you are at discount, price will buy to premium. If you are at equilibrium, price is likely consolidating. So why those two questions, you might wonder, why those two things? Well, this is what ICT said. Again, direct quote. Price is gonna go up for buy side liquidity, or it's gonna go up to trade into and reprice to inefficiency. Price is either gonna drop down for sell stops or sell side liquidity, or it's going down to reprice and inefficiency below price action. That's the only two functions that price does. Now, what ICT was saying basically is that when price goes higher, it's going for buy side liquidity or an inefficiency. And when price goes down, it's going down for sell side liquidity or going down to an inefficiency below the price action. So pretty much only two things the price is kind of concerned with, or only two things the price does is go up for buy side liquidity or imbalances, inefficiencies, right? Or go down for sell side liquidity or inefficiency in price. It depends on what is there and also what is the order flow. So anything apart from that is going to be a consolidation waiting for sentiment to build up, and then markets will run to where majority of liquidity will be. If price is not doing either of those two things, then it's likely in a consolidation. And of course, from a consolidation, price again will expand to where there's liquidity. So, having talked about those two things, right? We discussed them and how we use them to determine a narrative. So let me show what it looks like on the chart right here. So if price takes out a liquidity pool, then it's likely to retrace back inside the range. See right there? And then when price rebalances the fair value gap, then it's most likely to expand towards liquidity. In this case is buy side liquidity over there. So price takes out liquidity pool, retraces back inside the range, rebalances the fair value gap, expand towards buy side liquidity. And the last term for us to define is the drawn liquidity. So what is the drawn liquidity? It is the level the price is drawn to, or where price is likely to gravitate to. Now, the narrative will give you the drawn liquidity, and the drawn liquidity will give you the bias. And the drawn liquidity can either be liquidity pool, previous session highs and lows, inefficiencies, etc., etc. So this will be your process. On the weekly chart, you look at the weekly candle and ask yourself if it's likely to expand higher or lower. And how would you come to that conclusion? Well, you look for an imbalance higher or lower, or a liquidity pool. This will be the draws on liquidity on the weekly time frame. So if you have an obvious draw on liquidity, then that is likely where the weekly candlestick will be drawn to or will expand to. And also make sure to mark out the daily range. Then on the daily chart, where are the liquidity pools price can seek? Okay, you identify the liquidity pools, and then if it's buy side liquidity price is running for, then that's where we're going to see um, expansions in price. And we're going to be seeing movement towards the buy side liquidity. If it's some kind of swing low, then we're going to be seeing price seeking that sell side liquidity and moving in such a direction, right? So the drawn liquidity is usually found on the daily chart. Right? You just spoke the drawn liquidity is where price is drawn to, or where price is going to gravitate to, where price is being attracted to, is being pulled to. And so as a result, you're going to be spending a majority of your time on the daily chart. And I'll show you why this is so. So on the weekly chart, okay, the same thing we just talked about, just to determine what price is likely to do, because this is a higher time frame. So it kind of takes quite a long time for price action to really, for price to do anything significant. It really takes a long time. Look here. So the same thing you talked about. If price rebalances the fair value gap, then of course it's gonna expand towards the liquidity, right? Someone here rebalances the fair value gap, expand towards liquidity, and if price, because this at the time was an all-time high, so of course you're not gonna see immediate price retracing back to this range because we wanted to create the new all-time highs at the time. But see, with this low here, we take out this low, we retrace back inside the range and all that good stuff. We'll talk about some more. Now, we three things you must do, right? One, well, to determine where a weekly candlestick might expand to, you gotta also still be able to use those three things we talked about: liquidity pools, fair value gap, and also make sure you're making out the daily range. So with this daily range that we have here, so currently we're just trying to analyze the weekly chart. See, price creates a fair value gap, and you see in this week price rebalancing that fair value gap. Now, using what we just learned about narrative is that if price rebalances such a fair value gap, we're gonna see we expect to see an expansion towards buy side liquidity. And that's what happened. Right? So reasoning on narrative on the weekly time frame is pretty easy. Price is either heading towards an imbalance or heading towards a liquidity pool. I'll be showing you along this price action here what price can do. For example, here when price took out this all-time high, see a rejection from that, price quickly returned back inside the range. On the next range here, we have from this high to this low. Okay, that's our daily range. And so when price started to buy up, remember that drawn liquidity is where price is gonna be drawn to, or is gonna gravitate to, is gonna be pulled to or attracted to. And the most the easiest draw some liquidity is imbalances or liquidity pools. Now, price is either heading for one or two, it's either going to an imbalance or a liquidity pool. So you're always in the position to ask yourself, what do I have in price? What is there in price that is going to be the drawn liquidity, or the nearest thing in price that is the drawn liquidity? So yeah, when price started creating the swing low started to go higher, the fair value gap here will be your drawn liquidity. Okay, if it's your drawn liquidity, that means from here until price reaches that drawn liquidity in premium, you are looking for buys, right? You are looking for buys. That means you want to see bullish price action, so you're only looking for bullish setups, because that's the ones that will take you on, or that's how you're going to be placing yourself on the right side of price. Now, let's look at another range. Okay, let's look at this one here. So then price reaches up into premium with that, right, and then solves some more. Now, from this high to this low, we have a different range. Okay, price starts to go up now. Okay, creates a swing, goes high. It's in discount, it's going high. Now, the reason why we have different ranges, or we identify them anyway, because price will move from discount to premium. We spoke about this in the premium and discount video. So price will move from discount to premium. And in doing so, that means we are always going to be looking, if say prices in discount, we're always going to be looking for draws on liquidity in premium. What price going to be drawn to in premium? We will fair value gap here in premium. So all from here all the way until we reach the fair value gap, we are bullish because of that. And our reasoning will be, we have a bullish, we have a drawn liquidity in premium, bearish fair value gap there. So draws liquidity is not where we're going to be selling or where we're going to be entering, but is where we are trading to. That means we're buying to the drawn liquidity. That's why I'm saying from here until we reach the drawn liquidity, you would be bullish. See, the narrative is, firstly, remember we just taken out the liquidity pool here, so we're trading back inside the range. And the other thing is we're moving from discount to premium. So that's reasoning behind your buys. In narrative, then you give us the drawn liquidity, which is the favorite gap. And the drawn liquidity will give us the buys, which is bullish, right? We start there until we reach a conclusion that we are bullish because of this. However, having a daily bias doesn't mean buying or selling every day. Instead, as traders, we wait for specific conditions to meet our expectations, such as discount arrays for bullish buyers and premium arrays for bearish buyers at specific times of the day. In any case, as you see, I've denoted this here, which is actually a mitigation block. So we have a high, low, and a low high, and you break that. Remember at the time this was the all-time high for volatility 75, and so there's a mitigation block, and of course you see a rejection on that on the weekly time frame throughout the span of that year. And let's look at this daily range here as well. Okay, so now this impossible move anyway, because it appears that there's been a shift in structure. Okay, price is going to be bullish, and that's why I'm measuring this range of price, the bullish, or this range, really, the uptrend, so to speak. Now the trend has shifted. All right, so we have premium here and discount here. Again, remember we have that weekly period array, the mitigation block. So of course, price is likely gonna have a reaction on that, and that's what price does. It starts to sell from then. What's gonna be your expectation? Well, how are you gonna determine your narrative here? Firstly, price is gonna move from premium to discount. Then two, your drawn liquidity. Remember, I spoke about if price is selling at premium, we're gonna be looking for premium. If price is selling at premium, we're gonna be looking for discount drawn liquidity. And if price is buying at a discount, you're gonna be looking for a premium drawn liquidity. So in this case here, since we're selling in premium towards discount, then you're going to be looking for a discount drawn liquidity, which in this case is this fair value gap. You have a fair value gap in discount. That's a drawn liquidity. That means from here, where it starts selling all the way until it reaches that drawn liquidity, you are bearish. That is your bias, and that those are your reasonings, right? Premium to discount, and also the fact the price is reacting off of or rejecting off of a mitigation block, definitely setting off a mitigation block, right? On the weekly, so you get this kind of clear-cut picture from the weekly. Let me tell you something. If you looked at price on the lower time frame, you wouldn't know, or you wouldn't be able to see price as clearly as you see it on the weekly. Yeah, and I believe I mentioned this before, but let me mention it again, that hard time frames take precedence, right? What happens on the hard time frames is what the low time frames will conform to. So whether you're a day trader or what, you need to know the picture of the hard time frames. You need to know what price is saying, what price is doing on the hard time frames. That is what frames the lower time frames. The structure that is there, that's what gives it structure. The picture that you get from the hard time frames. And also, that's the right way to get proper narrative on the hard time frames. And that's why we move from weekly to daily, right? Daily, of course, is definitely where we're getting our bias, and that's where we're going to spend most of our time. But we need narrative from a higher time frame than daily, so we actually can get it on the monthly and also from the weekly. I prefer to use the weekly and the daily. So because we're going to be spending a lot of time on the daily, let me show you on this one here, all right, price action, how the daily looks like. This is what the daily time frame looks like. We're going to review this using what we just talked about with regards to determining narrative. And narrative will give us the drawn liquidity, which will give us the bias. So we only have like two questions, right? One, have we rebalanced the fair gap? See here, and the answer is yes. Then price is likely to expand to liquidity. So in this case, it's going to be a sell side liquidity. So price rebalances the bearish fair gap. It's most likely to expand towards sell side liquidity. So that means if our answer is yes, we have rebalanced the fair gap, then that price is gonna expand towards sell side liquidity. That liquidity pool is our drawn liquidity. Then that means we have a bias from the fair value gap to that liquidity pool. We are bearish. Remember, it doesn't mean that we're selling every day, but it just means we have expectations of what price is likely to do and reasons behind those expectations. So then price starts to reverse that and expand towards sell side liquidity. But before that, it created another fair value gap. See if the price takes that, retrains back up to that fair value gap, rebalances it. Again, if price rebalances the fair value gap, it's going to expand towards liquidity. Right. The other thing was if price is taken out of liquidity pool, it should retrace back inside the range. That's what happened here. Take out this liquidity pool and then retrace back inside the range. Take out this liquidity pool, retrace back inside the range. Very low, price runs higher to take out this liquidity pool. What do you expect when, if the answer is yes, that have we taken out the liquidity pool? Then yes. right here, then we trace back inside the range. Price creates a fair value gap. If we rebalance the fair value gap, yes, price is likely to expand towards liquidity. Now, what I found in my experience is that the low that is created when price retraces back up to a fair value gap is the one that will be targeted, or the one that the liquidity that we should actually be more of targeting or want to see price reach for, as opposed to ones as opposed to any other ones, really. Okay, like for instance here, when you create this liquidity pool, right? See, in this case though, we don't still go down a bit before retracing up to the fair value gap. Immediately you create that fair value gap, we trace back up to it on the very next candlestick. That doesn't give us a swing low that retraces back up to that, but still we still have relatively quite lows because this candlestick did not take out this low. And so upon rejecting of the fair value gap, that is exactly where price is going to reach for our target for sell side liquidity, those relatively quite lows. And so day one and day two, your bias is bearish, right? Price takes that out and then retraces back inside the range, expands, takes out this liquidity pool, retraces back up inside the range, rebalances the fair value gap. From fair value gap, we're going to expand towards liquidity. Price expands, creating a fair value gap, retraces back up to that fair value gap, right? Rebalances it and expands to sell side liquidity. So from here, we expected price to reach for this low, right? Price does, you know, but the time, of course, is killing two birds with one stone because we have relatively cold lows. We take out this low. What does price do? Or what do you expect really when price takes out liquidity pool to retrace back inside range? Retrace up, creates a high, and takes out that high. And of course, retrace back inside the range with an expansion, retracement to a fair value gap. If price rebounds the fair value gap, you expect price to expand towards liquidity. In this case, sell side liquidity, and this one as well. All this while, what price has been doing is moving from premium down into discount, into premium, to discount, into premium, into discount. And then price, we had an expansion down, it dipped into deep discount, right? Right at this order block right there. And you see an expansion higher now, right? Now price is gonna move from discount to premium. At this time here, we see price rebalancing fair value gap, and so the expectation will be that price is gonna expand towards buy side liquidity. That means from here all the way until price reaches that high, our bias is bullish. So 1, 2, 3, 4, 5 days you were bullish, or you had a bullish bias, and this was your reasoning that we rebalance the fair value gap, so we're expanding towards buy side liquidity. Same as here, although price was going to a consolidation after taking out that liquidity pool here, it did retrace down into a fair value gap, and of course, if price rebounds that, right, that means it doesn't break through the fair value gap. We respect it. Should expect it to expand towards buy side liquidity, which in this case is what the high or the swing high that's created when price retraces down to the fair value gap. So this one here will expand up. And we take that, and if price takes out liquidity pool, you expect it to retrace back inside the range. And this goes on and on and on. So we apply this across, and consistently it will give you very good grasp on bias. Now we're gonna add some on that. Let's talk about how the market moves. So there are three ways. These are very three significant principles. Okay, how the market moves, and it's a for sure case that price is doing one or all of this at any point in time. When you analyze the price, when you're looking at the market, you're gonna be seeing them playing out exactly as you expect them to. Number one, price moves from buy side liquidity to sell side liquidity, and from sell side liquidity to buy side liquidity. This is how it looks. If price takes out sell side liquidity, the next thing the price is going to move for is buy side liquidity. Another example, take out buy side liquidity, then we're going to take out sell side liquidity next. You take out buy side liquidity, then we're going to take out sell side liquidity next. take our sell side liquidity here, then we're going to take our buy side liquidity next. And if you take our buy side liquidity, then we're going to take our sell side liquidity next. Okay. Number two, price will move from internal range liquidity to external range liquidity, and from external range liquidity to internal range liquidity. External range liquidity is the high and low of a range. Okay, when you have a daily range, the higher that range is where you have buy side liquidity, the lower that range you have sell side liquidity. That's your external range liquidity. Then internal range liquidity will be anything in between. That is all highs, lows, level gaps, order blocks, breakup blocks, mitigation blocks, rejection blocks, etc., etc., liquidity voids and all that. Then the last and foremost, of course, we dealt with this one before. The price will move from premium to discount and from discount to premium. Let's look at the recent price action and see how we could have come up with an idea of where price is going to go to next. For context, what price did is take out the weekly liquidity pool. Now let's head down to the daily. So after price took out that weekly liquidity pool, first in price did kind of created a low here. Okay, retrace back up to this fair gap here, and expectation then if it rebalances that, it's going to expand for sell side liquidity, which is here, which is this low created right by that retracement going up, and eventually price creates a swing low, right, retraces back up. Now we spoke of three things: one, internal to external, external to internal liquidity, right? And two, buy side to sell side, sell side to buy side. So pretty much what price did here is go for expand at least towards this buy side liquidity here, because above swing highs and swing lows rest liquidity, right? In this case, buy side liquidity here. So we expand towards buy side liquidity, and again we expect after price takes out liquidity to put you trades back inside the range, and that's what it does. But in this case, it's in this high to this low. If that is the range, you didn't range, okay? If that is you didn't range right then that's your external range liquidity. That's your external range liquidity. And anything between those, that fair value gap here, this order block, that's your internal range liquidity, right? So price moved from internal, okay, to external, and from external we're gonna move down to internal range liquidity, which in this case will be say this fair value gap. Okay, price also did touch on the order block high here, and then what happens next? Price will move from internal range liquidity to external range liquidity, right? And then of course from external again we'll move to internal range liquidity. And where do your eyes go to? Well, this fair value gap here and this low here, and the other third one will be premium and discount, right? It's still moving from premium to discount, discount to premium. So price will move from premium down to a discount, internal range liquidity, which is this low, right? This fair value gap is premium, so we're not going to consider it. We're going to consider this low. So this low will be the next from liquidity, and so your buyers will be bearish with those, with that as your reasoning, moving from external range liquidity to internal range liquidity, and price kind of creates like relatively colors here, okay. And then of course what did price do after that? After taking this liquidity pool, retracement back inside the range from this high to this low, take your fib, price will move from discount to premium and from premium to discount, right? And if you remember on the 4-hourly time frame, that this price was selling off of a 4-hour order block, right? Right there, price sold from this 4-hourly order block. So it's back again on the daily. So Again, still part of interrange liquidity, and then price is gonna move to external, which in this case is this low, not this low here. When you look at this range of price, this high to this low, price still got the buy side liquidity here. That is the external range liquidity. And then now we're gonna move on to interrange liquidity, this low and this main threshold of this order block here. Then price is gonna retrace up to premium. So moving from premium to discount, then discount to premium, then also back again to discount, which is also when price is moving from the internal range liquidity to external range liquidity here. So it's like a couple of things, right? Three things: external to internal, buy side to sell side, and premium to discount, discount to premium. So the continuous cycle of that. One, in this case, we'll take it external range liquidity and then move into internal range liquidity. And the other thing is, this is buy side liquidity. And if you look at this range, if this is where buy side liquidity is, then where is sell side liquidity? Sell side liquidity is right here. So eventually we'll move from buy side to sell side, and from internal to from external to internal, and then from internal back to external. Okay, so then also from premium to discount, and discount to premium, and then premium back to discount. Three things. See, all those have been asked to determine the bias or determine the likely direction of price. And so price in here, from here all the way until price reaches this low, here's your bias, you're bearish. Price rejected that main the main threshold of the order block, price is gonna move from discount to premium. Okay, and you had a very obvious premium P area there, which is the 4-hour order block, and that's where price sold from. Now price is selling there. Of course, this low is going to be your nearest drawn liquidity here. Okay, but never forget, we're moving from internal to external, and so this will be your external range liquidity where it is. So now price taking out the external range liquidity. Again, when price takes out liquidity pool, what do you expect to happen? You expect price to retrace back inside the range. And if this is internal external range liquidity, then if price takes out external range liquidity, the next thing price will seek for is internal range liquidity. Where is it in this range from this high to this low? Well, if price does create a swing to go higher, this will be the nearest drawn liquidity, which is this fair value gap here. Although it might be in discount. Actually, it's fine. It's a bit in premium. So that will be the nearest drawn liquidity if price does, actually create a swing to go higher. You can trade in line with this. You can trade with anticipation the price will reach this fair value gap. Pretty much that's how you put all those tools in place. And yeah, that's it on today's video.